On October 19, 1987, the stock market experienced its largest one-day percentage drop in history, known as Black Monday. What caused such a dramatic plunge, and how can such events impact your investments? In this video, I will demystify the stock market's inner workings and shed light on the risks that can affect your financial future. What is the stock market? In a world where financial headlines can impact your wealth in a split second, understanding the stock market becomes essential. The stock market is essentially a gigantic network of transactions where people buy and sell shares of companies. When you buy a share, you're purchasing a tiny ownership stake in that company. This means you are entitled to a portion of the company's profits and may have a say in key company decisions. Unlike bonds, which are loans to a company or government that they promise to repay with interest, stocks represent equity or ownership. Bonds are a form of debt, while stocks are a claim on the company's future earnings and assets. Major stock exchanges, such as the New York Stock Exchange and NASDAQ, serve as the central hubs where stock transactions take place. These exchanges provide a structured environment for trading and ensure that buying and selling happen smoothly. Before a company's shares can be traded on these exchanges, it must first go through an initial public offering, or IPO. An IPO is the process through which a private company offers its shares to the public for the first time, raising capital to fund its growth or other needs. How stock prices are determined? When you see a stock price jump or fall sharply, it often leads you to wonder why such changes happen. The truth lies in understanding how stock prices are determined, a process influenced heavily by earnings reports and valuation metrics. Earnings reports released quarterly reveal a company's financial health. They include crucial figures like earnings per share, or EPS, which tells investors how much profit a company makes for each share. A higher than expected EPS can boost a stock price because it signals strong performance. Conversely, if earnings are lower than anticipated, it can cause the stock price to drop as investors react to the negative news. In addition to earnings reports, valuation metrics play a significant role in determining stock prices. One of the most important is the price-to-earnings ratio. This metric compares a company's current share price to its earnings per share, helping investors gauge whether a stock is overvalued or undervalued. A high price-to-earnings ratio might indicate that the stock is overpriced relative to the company's earnings, while a low price-to-earnings ratio could suggest it is undervalued and potentially a good buy if the company's future prospects are strong. By keeping an eye on these factors, you can better understand the forces driving stock price changes. It's not just about numbers. It's about how those numbers reflect the company's overall performance and market expectations. Key drivers of stock prices. The forces behind stock price movements are both fascinating and complex. A company's performance and the news surrounding it play a central role in shaping stock prices. When a company reports strong earnings or announces significant achievements, such as a successful product launch, its stock price often rises. For example, if a tech company unveils a revolutionary new gadget that is expected to boost its sales, investors might drive up the stock price in anticipation of future profits. Conversely, negative news like a drop in revenue or regulatory issues can lead to a decline in stock price as investors reassess the company's future prospects. Equally important are market sentiment and broader economic factors. Economic conditions, such as recessions or inflation, can influence investor confidence and impact stock prices. For instance, during an economic downturn, companies might struggle to maintain profitability, which can lead to a general decline in stock prices. Additionally, geopolitical events or significant economic policy changes can create uncertainty in the market, causing stock prices to fluctuate. Understanding these key drivers provides insight into how various factors can affect stock valuations and helps investors make more informed decisions. Benefits of investing in stocks. The potential for long-term growth in the stock market is a compelling reason to consider investing. Historically, the stock market has shown impressive performance over extended periods. On average, U.S. stocks have returned about 9.2% annually over the past 140 years. This growth reflects the market's ability to generate wealth over time, benefiting investors who stay committed. For instance, if you had invested $1,000 in the stock market 30 years ago, that investment would have grown significantly due to this consistent average return. Such historical data illustrates how patient investors can see substantial gains, making long-term investing a powerful strategy. Dividends add another layer of appeal to stock investments. A dividend is a portion of a company's earnings paid out to shareholders, typically on a quarterly basis. For example, if a company pays a dividend of $1 per share and you own 100 shares, you would receive $100 in dividends. These payments can provide a steady stream of income and enhance overall returns. Dividends are especially valuable for long-term investors as they can be reinvested to purchase more shares, compounding your investment growth. Together with capital appreciation from rising stock prices, Dividends offer a way to earn additional returns while holding onto your investments. Risks of investing in stocks. When considering stock investments, it is crucial to be aware of the risks involved. One major risk is market volatility, which refers to the fluctuations in stock prices that can happen from day to day or even hour to hour. This volatility is often influenced by news, economic data, and market sentiment. For instance, a sudden political event or economic report can cause stock prices to swing dramatically. Emotional trading, where investors buy or sell based on fear or excitement rather than sound analysis, can also contribute to these swings. The unpredictable nature of the market means that stock prices can drop significantly, sometimes without warning, which can be unsettling for many investors. On a more individual level, each company presents its own set of risks. A company's stock performance is closely tied to its financial health and management decisions. Poor management, unexpected losses, or failing to adapt to market changes can negatively impact a company's stock price. For example, if a company faces a significant scandal or its earnings fall short of expectations, its stock value can plummet. Investors need to be vigilant about the companies they invest in, as these specific risks can lead to substantial losses. External factors also play a significant role in stock market risks. Economic downturns, such as recessions and global events like pandemics or geopolitical conflicts, can have widespread effects on the stock market. These factors can cause broad market declines and impact even well-performing companies. While it is impossible to predict every risk, understanding these factors can help investors make more informed decisions and prepare for potential market challenges. Tips for managing stock investment risks. In the world of investing, managing risks is as crucial as choosing the right stocks. One fundamental strategy to safeguard your investments is diversification. Rather than putting all your money into a single stock or sector, spreading your investments across various stocks and industries can help mitigate risks. For instance, if you invest in technology, healthcare, and consumer goods, a downturn in one sector may be balanced by gains in another. This way, you reduce the potential impact of a single poor-performing investment on your overall portfolio. Another vital aspect of managing stock investment risks is thorough research and due diligence. Before making any investment, it is essential to understand the company's financial health, market position, and growth potential. This means examining financial statements, staying updated with company news, and considering broader industry trends. Being informed about current market conditions and economic factors can also help you make smarter investment choices. Investing time in research not only helps in avoiding costly mistakes, but also improves your chances of making well-informed decisions that align with your financial goals. By implementing diversification and conducting careful research, you can effectively manage the risks associated with stock investments and work towards a more secure financial future. Knowing how stock prices are driven and the risks involved is essential for any investor aiming to stay ahead. How do you handle market volatility in your investment strategy? Let us know in the comments, like this video if it provided value, and subscribe for more content. If you have any specific topics you're curious about, we'd love to hear your suggestions for our next video.